Robert owned a small delivery company in Ohio. Like anyone trying to get a new operation off the ground, he was relentlessly focused on growth, and that meant scrutinizing every dollar that left his bank account. When he looked at the premiums for comprehensive business insurance, the cost felt difficult to justify. His operation was small, just a few vehicles and a handful of employees. He ran the numbers and convinced himself that the statistical odds of a disaster were low enough that he could safely skip the coverage. For years, that calculation appeared correct. Deliveries were completed on time, customers were happy, and every time Robert looked at the cash reserves he was building by not paying those monthly premiums, he felt his decision was being confirmed by the market. Psychologists call this optimism bias. It is the exact psychological trait that gives an entrepreneur the courage to start a business in the first place, the belief that things will go your way. But when it comes to evaluating risk, that same optimism becomes a substantial blind spot. Skipping insurance protection does not increase long-term profit margins. It quietly and steadily accumulates a growing hidden liability. One rainy Tuesday morning, the odds finally caught up with him. One of Robert's drivers lost control on a routine route, resulting in a severe multi-vehicle highway collision. The immediate consequences were exactly what you would expect. Several vehicles required major repairs, and the initial medical bills for the injured parties started coming in. This model demonstrates the multiplier effect. A localized accident acts as a starting node, rapidly branching out into distinct liability categories: medical care, property damage, and legal action. As legal notices and settlements are calculated, the financial weight dwarfs the initial cost of fixing a truck. Finally, a comparative chart emerges. The tiny bar represents years of saved premiums, while the towering bar next to it represents the compounding out-of-pocket expenses he now owed. An unprotected risk carries an exponential penalty. It triggers a mathematical drain that vaporizes years of calculated financial gains in a matter of days. While Robert was still trying to manage the fallout from the crash, a severe storm swept through Ohio and critically damaged the roof of his main warehouse. Water poured in, destroying vital inventory and ruining equipment. Because the company's cash reserves had already been drained by the highway accident, there was no money left to replace what was lost. Operations ground to a halt. The internal chaos quickly bled out to the customer base. Deliveries were delayed, projects stalled. Frustrated clients who had relied on Robert's previously stellar track record began pulling their contracts and taking their business to competitors. The entrepreneur who once focused entirely on growth was now spending every hour trying to manage a decline he couldn't stop. He was isolated in a warehouse he couldn't afford to fix, watching the business he built piece by piece begin to unravel. When every resource is spent reacting to fires you can no longer afford to extinguish, you lose the ability to lead. The crisis doesn't just halt operations. It forces a business into a permanent defensive crouch. Late one evening, reviewing depleted company finances, Robert sat down with a business advisor. The advisor looked over the numbers and asked him to consider what would happen if those exact same events struck at a larger scale. The answer was mathematically undeniable. The business would have been forced into total bankruptcy. This model illustrates the concept of a financial firewall. It repositions comprehensive insurance away from being a reluctant monthly expense and turns it into a proactive structural defense. Recognizing this, Robert spent the following months painstakingly rebuilding. He purchased proper coverage, audited his operational vulnerabilities, and installed strict new safety protocols. An insurance policy cannot stop an accident from happening. It serves as the structural barrier preventing an accident from initiating a fatal chain reaction. A year later, a delivery vehicle suffered heavy structural damage in a severe nighttime highway collision. But this time, the outcome was completely different. The claims process activated immediately. The repair costs were covered, the financial impact was contained, and the rest of the business kept running without a hint of panic. There is a persistent myth among business owners that you only buy insurance to protect against highly improbable, headline-making disasters. The mundane reality of operating a company is that equipment breaks, storms hit warehouses, and accidents occur. These events happen every single day. It takes immense personal sacrifice and thousands of hours to build a successful operation. proactively shielding it from the everyday risks of the real world is the only way to ensure that all that work wasn't for nothing.